Skenjana is an economist and managing director at ESG Analytics. Sifiso, good afternoon to you. Thanks for your time. So we have some growth, thank goodness. Is there any indication that growth is picking up at all?
Good afternoon, Stephen, and of course to the listeners at home. I think it depends at a sectoral level where we're looking, Stephen. When we look at, of course, agriculture, they've had a bumper season and they've had 5 consecutive quarters of positive contribution to that GDP print. But also that agricultural print has been quite volatile historically, where, for example, in Q3 2023, we saw agriculture regress by about 19.5 percentage points. And so, it is a sector that I think has supported the GDP print for Q4 2025. And certainly now with everything that's happening in terms of the war between Iran, the US, and Israel, that's going to impact cost of fertilizers as well, notwithstanding the inflation impact it may have. And so I think we might see a negative swing in agriculture in the quarter that's coming. Manufacturing has structurally and construction actually been quite bad in terms of performance. I looked at about the last 10 quarters of performance, and manufacturing remains, I think, quite a weak contributor there. And in fact, one of the things we looked at, Stephen, is then around sectoral value added. And what we saw there, about 75%, and so 3 out of 4, 75% of the contribution that's coming from value added services coming from the tertiary industries. And so it's really telling you about our secondary industries are struggling, our primary industries are struggling. And I think this is reflective in what we are seeing in this current print.
There's been some expectation that perhaps with all the reforms, Operation Vulindlela, keeping the lights on, the ports improving, all of those things, that growth would start to pick up. Have we done enough to, at the very least, start create an enabling environment for companies?
Sure. I don't think it's enough, Stephen, but it's definitely a step in the right direction. Of course, we want to see an improvement in some of those ease of doing business rankings. We had at some point being ranked number 25 in the world in terms of ease of doing business, Stephen, and now we're all the way at 84. And so there's been a massive structural break in the way in which businesses are able to conduct businesses. We're seeing, of course, reform proposing the electricity market and the mining spaces in terms of licenses, etc. And so these are some of the things that we're hoping that start to release a little bit of growth into this the economy. But I think, Stephen, we really do need to see that gross fixed capital formation, really, in essence, investment-led growth, really, I think, start to become the key driver of investment growth in South Africa. We can't continue to see growth only coming from household expenditure in a meaningful way. With now, of course, exports also, I think, struggling in essence to perform. We really need investment-led growth, and I think that for me is the thing that really must continue to be emphasized. We saw the World Bank today or yesterday announce a 450 million infrastructure facility that they're giving to South Africa, in essence, which looks like a credit loss guarantee facility that is expected to fast-track bankability of some of the infrastructure projects. So those are some of the things, Stephen, that we hope can start to galvanize and catalyze the right level of growth and the right structural transformation. So making sure that growth is coming largely from the primary and secondary sectors. That means that is then growth that can be absorptive of the labor context that we have as well.
None of this is going to happen if we have oil prices at over $100 a barrel, as we saw yesterday and over the weekend. If that continues, and this, of course, is because of the conflict in the Middle East, but if that continues, I would imagine growth is off the table, inflation gets high, interest rates stay high.
Sure. Yeah, I think it is a big question mark around the impact that it's going to have on our next inflation read. Certainly what we have seen in terms of the research done by the Reserve Bank is about 25% of the variation that we see in our inflation print is directly attributable to the oil prices. And so that means, when you see then oil prices move from at $67 odd to 120 at some point, that then is going to have a material swing factor in terms of our inflationary outcomes. It might improve improve our export performance, but I think the offset impact in terms of the pressure on inflation, the pressure on the interest rate, and therefore the cost of borrowing in South Africa at a household level, where an economy, as we're saying, is largely driven by household expenditure, is really, I think, going to definitely, put a blip on our growth expectations. But also, Stephen, I think there must be, questions that we also continue to ask about the strength of our economic forecasting, because again, I did an analysis of the last 10 quarters, and we've undershot our expected or published print expectation of growth by 0.3 percentage points every single time. That's about the average undershoot. And so when we're hearing now expectations of growth at 2%, we must probably be reading at that about 1.6% in terms of real field growth in the economy. And so these are some of the things that we also need to, I think, look at more intently and say, have we gotten a good understanding of the real growth drivers and the sustainability of those drivers insofar as they inform the print and the forecasts from our GDP expectations?
Sure, lots to think about. Thank you very much indeed. Sifiso Skenjana is at ESG Analytics.